working professional from Kolkata. Until now, he was filing his taxes based on the old tax regime. But after the Modi government brought in a new tax system in the 2020 budget, Subrato was confused which one he should opt for. Although the Union Budget 2022 did not make any significant changes in the tax slabs, be it the old tax regime or the new one, which was introduced in 2020. So how does a taxpayer like Subrato decide whether to go for the new or the old tax structure? Now, there is a lot of confusion about new tax regime. People are not able to decide which one to opt for. Choosing between the tax regimes might depend upon various factors such as current income level, income composition, that is sources of income, investment appetite, and saving habits among other factors. The new tax regime is different in two ways from the old one. Firstly, it has more slabs with lower tax rates. And secondly, all the major tax exemptions and deductions available to taxpayers in the existing tax regime are not allowed if the new tax regime is chosen. The main difference between the old and the new tax regimes is the difference in slab rates. So the taxpayers with higher incomes will be liable to pay more in taxes. The new tax regime is available only to individuals and HUF, and it is optional. The new tax regime offers you concessional rates up to income of Rs 15 lakhs with tax slabs of 5%, 10%, 15%, 20 and 25% on the income slabs advancing by Rs 2.5 lakhs. The cumulative benefit for moving to a new tax scheme is around 75,000 rupees, plus 4% cess if your total income is Rs 15 lakhs. As for deduction, it is not allowed under the new tax regime, but a taxpayer has a lot of options in the old tax regime. While the new tax regime offers the taxpayer to claim zero deduction or exemption options, the old tax system provides around 70 deductions and exemptions to lower their taxable income. As far as salaried people are concerned, they will not be able to avail major benefits like standard deduction, house rent allowance, leave travel assistance, etc. in case they opt for the new tax regime. As for the retired senior citizen, they will not be able to claim standard deduction in respect of pension from ex-employer as well as deduction in respect of interest from post office and banks if they opt for the new tax regime. But they do have a higher basic exemption limit and also exempted from tax on amount received such as gratuity, commuted pension, leave encashment and provident fund. Although there are certain conditions where senior citizens are not required to file ITR, says tax expert and chartered accountant Raj Chawla. From assessment year 2022-23, in case of senior citizens of the age of 75 years and above, having only pension income and interest income only from the accounts maintained with the bank in which they receive such pension, such senior citizens shall not be required to file their ITRs. Now you must be wondering which scheme works the best for you. Well, since composition of these tax benefits vary from person to person, there is no fixed answer as to which is the best option out of the two regimes. However, looking at the tax benefits which majority of the taxpayer have to forego, the benefits available with existing tax regime, that is the old tax regime, overweighs the benefits of the lower tax rates available under the new tax regime, especially in the case of salaried people and those who have taken home loans. How to switch between new and old scheme? If you are a salaried individual, you can make this choice every year. Individuals with income under the head of salary, house property, capital gains and other sources can choose every year to switch between the old or new tax regime. But the individuals who have income from business or profession get only one chance to return to the old regime after they opt for the new tax regime. They can choose the new tax regime only once in a lifetime. According to tax experts, the old tax regime is more popular among the people because they get the benefit of tax exemption along with investment in social security schemes. On who should opt for the new and old regime, Raj Chawla says most taxpayers benefit from being in the old regime when they maximize Section 80C and go for tax deductions and benefits available in their salary structure, such as claiming HRA, reimbursing a part of CTC, etc. It is the younger population which does not have many tax savings investments and is picking the new tax regime. In his opinion, many taxpayers are opting for the new regime as they want to avoid locking the funds under Section 80C investments, which features a lock-in period. These taxpayers choose to invest in FDs rather than locking their assets in tax-saving options for 3 to 5 years. Money9 suggests, if your annual income is on the higher side, the old tax regime is a better option than the new one. The new tax regime is tailored to new investors and individuals who have only recently begun their careers, as their income has only recently begun. The only way to determine which is better for you is to calculate your income using both regimes to determine the actual tax payable.